This next session is quite punchy, deliberately, because I thought we've just got to get right in there with what the problems are. So I thought that the final comments of Eric kind of really set the scene, which is all about technology revolutions, and in fact, a lot of people can be worse off, can't they, with rising inequality. So we're here to really find out how can asset management be a problem solver and really help the evolution of financial and health well-being, bringing together the concepts of well-being. So I'm delighted to have my fantastic panel. I've got the CIO, Michael O'Sullivan, former CIO of Credit Suisse and now author of The Levelling. I've got the customer advocate here, Rose St. Louis, head of strategic partnerships at Zurich. And I've got the product expert here, Bill Gourlay, head of product development for Aon. So we've got a fantastic team. So we'll start with you then, Michael. Can you give us a bit of background then about the macro situation and inequality?
I will, of course, and good morning. And before we come to tech revolutions, I'll start with political revolutions.
Okay.
And I've sort of lost touch of the number of people who come up and say we live in interesting times. And I think the world, in particular our industry, is still living in the echo of the global financial crisis and sort of the end of globalization. And of course, you're seeing this being played out in politics. In Denmark, there was a recent election, and instead of going to the extreme left or right, people went to the center. They're doing different things in other countries. And I suppose the response of our industry to all of this is ESG, maybe to be a bit more responsible. And different people are doing it to different degrees of quality. And I think there are two huge tectonic things in markets that vastly distort the markets we have to work with and vastly distort asset prices. And they are, first of all, central banks and the near permanent continuation of QE. And I kind of compare QE to morphine. You know, a doctor will give a patient morphine sort of the first day or two in hospital, but they won't give it to them for 7 years. And that I think, is what central banks have done. And that has pushed asset prices to extreme levels. We now have 20% of all the bonds in the world at negative interest rates. And that has huge implications for older people, for millennials. And then related to that is indebtedness. And indebtedness has been spurred by what central banks have been doing. The world is now as indebted. You've got to go back to the Second World War, and then before that, the Napoleonic Wars, to find a time when the world was as indebted. And to many respects, this makes ESG more important. It certainly makes the G component, governance, very, very important as we head towards sort of the downside of the credit cycle. And it also makes the S component much more important to the industry in the sense that many people will have to try and deal with lower returns in the future.
It's certainly a problem. So how can we apply AI and new technology to try and address these fundamental issues?
Sure. Well, so from an Aon perspective, we are providing services to the sort of big corporate institutions across a raft of things, including catastrophe and ransom and kidnap insurance, but also then into the retirement and welfare space. And you know, some of the big numbers that we need to think about are that 72% of Americans, for example, worry about money. I'm interested what the other 28% are doing. They're obviously doing fine. And you know, the brutal truth is that high stress levels create a 32% more likelihood of death by cancer. So the awareness that we have is that providing solutions that recognise health and well-being in the industry are absolutely critical. And employees who have a good setup around those aspects are likely to cost you half the amount that those in a more unsettled situation would in terms of healthcare and turnover costs. So Aon launched a solution called Well One, and this is an app that tracks your physical, emotional, social and financial well-being. And it was designed certainly for Aon internally, but also for our corporate clients, and to take advantage of those opportunities to recognise the healthcare benefits of a well-employee workforce. And the way it works, it recognises things like a Fitbit, things like a smartwatch. It tracks and uses data analytics to understand what your targets are, what you're trying to achieve in your life, from a financial and a personal perspective, and then coaches you using AI, using data analytics in what you should be doing slightly differently. Some interesting first results from our survey, which may or may not be Aon. I'm probably not supposed to say who. 29 to 39-year-olds are below where they should be in terms of exercise. 50-year-olds, apparently in the phrase of our product manager, are smashing it. So if you're a mammal, that's a middle-aged male in Lycra, well done you. You're doing fine. In terms of other numbers, interesting in the graduate age group for us, 19 to 29-year-olds, female grads are not achieving their exercise target, male grads are, surprisingly enough, so well done you as well. But the important thing here, I think, is to position this in terms of the ability here of us to use AI and to use data to produce this information. Financial technology is not a new thing, despite the fintech buzzword. The venerable SWIFT that we've been, has been running the banking industry since '73. That's probably longer than most people have been working. In fact, probably longer than a lot of you have been on this planet. So, fintech is not a new thing. These opportunities are not a new thing, and it's all about adoption. There are a number of examples of blockchain today that I think are going to be around the conference that people might take advantage of. But again, blockchain is not necessarily a new thing. Any of you who had exposure to Australia around 2005, 2006 might have come across a slightly unlikely outfit called Global Funds Network, backed by a New Zealand meat packer, so a real entrepreneur. But the time was not right for their modular, nodal-based, non-messaging communication method for trading and for data management. To me, that sounds a lot like blockchain, but the time just wasn't right. But the interesting thing here is probably the asset management industry is not a cat. It doesn't have 9 lives, so how many times can it afford to miss the boat? And we heard about the Facebook Libra thing earlier today. I think Tom mentioned it at the outset. Facebook is there. It's got a credible opportunity to enter this space. So we need to be really cautious.
Rose, so you're really the customer advocate. How can we apply these new technologies to really personalise these solutions in a different way?
I think we hear a lot about use of technology and AI, which is hugely important, and it helps to drive efficiencies within our business, but I question within our sector whether the customer's actually feeling the benefit of that. I think that when we look at our sector and the benefit we feel that we provide, providing financial resilience and financial security for people's financial futures, whether it's through medium-term or long-term savings, ultimately, that's wonderful. But what's the customer? How are they receiving that? And I think about when we use data and technology, they have it through Facebook, Amazon coming at them, pushing their preferences, telling them what they need, nudging them through the process, and they don't have the same experience from us. They absolutely don't, and we need to move down that path quicker. Obviously, Bill talked about kind of like some of the Fitbit technology and what we can do, and I think that we're seeing more ecosystems. Eric talked more about ecosystems earlier, and if I think about an application of how we support that at Zurich in a connected homes way, so you've got this prevention and cure coming together. So you've got, detection units on pipes and windows and doors and digital and smoke detectors and all sorts of bits and pieces to make sure your house doesn't burn down, it doesn't overheat, no one breaks in. And if that worst happens, then there's the insurance that backs it up. What can we do within the asset management industry to pull those things together from a health and a wealth perspective? We know that people are living longer. We know that baby boomers are struggling to give their millennial children the money for deposits for properties and all that kind of stuff. So money that's been saved now to secure their financial futures at the end and maybe being tapped into and given away earlier, which means they're going to sit on platforms like Zurich or within the hands of asset managers for a lot less time. So what can we do to work with technology providers, health providers, insurers to look after the well-being of the customer, but also make sure that we run commercially viable businesses as well?
So what would these new products look like from the asset management perspective?
Well, I think that, you know, look at what the products could look like would be determined by what the problem is that we're trying to solve and what the data is. So, like my colleague here that can talk competently about the ageing population, I think that's a massive issue. Once we understand that, I think we can anchor back in. I don't know if you want to...
Do you want to then...
I will, of course, and I think
on that?
demographics is a good starting point. And I mean, there is a vast challenge for the industry that not even Eric Brynjolfsson's robots can solve. So if you look at the demographic cohort that's going through Europe, the States, and even China, people are getting older. And as they get older, growth will be lower, asset returns will be lower. And the challenge for this industry is that we've eaten up all the returns of the future. So the average return on the S&P index in the last 10 years has been 11, 12%. That's over twice the average return for the last 120 years. Again, if you look at the bond markets, most bonds are in negative, well, a fifth of bonds are in negative yield territory. And then you factor in the political response and sort of the war on profits that's going to come from, I think, politicians, and you see this already in the Democratic race, taxing companies more, having wealth tax. The likelihood is that average long-term returns in equity and bonds for the next maybe 10 years will be very, very low, perhaps even negative. And that's the big challenge, is how, first of all, does this industry honestly communicate that to people? And then how do you design products around it? And how do you design products, for example, for millennials, and also for the theme of longevity, where people are going to be living longer, up to, say, 90, 100?
Yeah. Have you got a solution? Then I'll come to you, Bill.
Well, I think that, you know, the solution originates from what's going to resonate, what's going to be meaningful for a customer. You know, so for me, it's really interesting, sort of like linking. I feel like I sit between both the customer world as well as the asset management world. And, you know, the measure of success for the customer we don't use that as a measure of success for ourselves. So we talk about, you know, what our returns are, whether we've beat the benchmark, and we've done really, really well, even if it's a negative return. Customer doesn't see it that way. Customer says, I need £500 a month to supplement my pension income. Whether you beat the benchmark or not, I still need that, and I might need that without eroding my capital, or I don't care as long as I've got the last payment before I die. So we need to be able to communicate the products that we have, or the next version of product we have, that meets that need, because that's the benchmark.
Yeah.
That's the benchmark for the customer. And I think that it's really important that we understand where we stand against our peers and how we're performing and what sits in our funds. That's really, really important. But that language cannot be used in our material, in our conversations with intermediaries, to have an intelligent conversation. Because from my mind, and the advisors that I speak to in the retail space, that's a really big gap to bridge, you know.
So what's it going to be called then? What is that kind of...
Well, I mean, I think, I won't put a name on it at the moment, but I think the industry needs to think a little differently. I mean, what we're doing today is just not working. 9 out of 10 employers are saying that employees don't use financial wellbeing products that are being offered, but only about 2 out of 10 of those are actually got a continuous feedback loop anyway to understand whether the employees are using it or not. And, you know, Michael mentioned the retirement gap. I mean, the World Economic Forum just came out with a relatively scary report that shows that UK retirees are going to outlive their savings by 10 to 12 years. And across the major 8 countries, we're at 70 trillion of gap in 2015, which will be 400 trillion of gap by 2050. So there's some really scary stuff out there that we need to do differently. And yeah, perhaps I can take a client example that we had, which maybe sort of talks maybe a bit historically about how to do things differently. We did some work with Cadbury, which most of you will probably be aware make chocolate. 1878, in the middle of the Victorian slums of Birmingham, Cadbury decided to actually build Bourneville, which is effectively an employee village. They built semi-detached houses with a garden, they put bathing facilities in, they put sports clubs in, they put kitchens in to heat up food. As a Quaker, they introduced morning prayers and Bible readings to support the family atmosphere. And you know, they weren't the only ones doing it. Lever Brothers did something similar at Port Sunlight. And we were having a conversation with Cadbury and we described them as benevolent and paternalistic, and they took massive offence at that. And I said, look, this wasn't just doing it out of the good of our hearts. We were making chocolate and we were dealing with unwashed, potentially drunk individuals in food hygiene. So we had a real reason behind doing this. We were trying to get a better product by looking after employees and delivering a better service. So they were happy with it being called commercial paternalism, so maybe that's the name of the product. But you know, even in Victorian times, there were examples already of people thinking that little bit differently, but to get the better outcome, both for their employees and for their business. And I think that's what this industry needs to do now.
Yeah.
I was just going to say, I think that's it, right? It's not one. There's no silver bullet. It's not one thing. It's a combination. Whether it's the connected homes we heard in the first track of the ESG yesterday around smart cities. So it's just not one thing. So I think that, you know, we're breaking out from the asset management industry, staying as the asset management industry and being able to service a customer need. I think those days have gone. I think that there needs to be more collaboration.
Yeah.
You know, we need to be working with insurers, other providers. We need to be working with health. We need to use this plethora of data that we have to be able to, you know, understand what that means from a health perspective. So how does that drive into savings? How people are going to be turning over their savings? What does that mean for us? How do we feel about a sector? What can we do to prevent that? Who should we go and collaborate with? So it is building or becoming part of a broader ecosystem to be relevant to the customer, because I question how relevant we are being to the customer. And I think about, you know, with regulation and the compartmentalization of advice, you know, you used to be able to get holistic financial advice for one person. Now you have to go to a mortgage broker, a wealth specialist, a protection specialist, and it's really hard for the customer.
Really hard.
It's so difficult. So, you know, how do we bring those things together, and how do we understand what the needs are, and how do we become relevant? We've got, you know, post RDR. There's an advice gap. We're not doing anything about that. Do we want to do anything about that? You know, we've got sort of like 20 years ago, platforms came into play. So you've got the customer sits shoulder to shoulder with the advisor. Then maybe you've got some investment committees. Then you've got the platform. Then you've got the asset manager. The asset manager want to get close to the customer, so they'll have a direct proposition. But it's not a direct proposition to fill the advice gap where there's loads of people that can actually put money into their investment proposition. It's to take a slice of the high net worth and the ultra high net worth. So we're fighting over the same stuff and still not being relevant to all those people that need help.
So how can we encourage asset managers to take some of the demographic sectors that have not been so attractive to the industry seriously? Can that only be done via the government, or how are we going to do that?
Yeah, so I think there's a few things. First, I think the so-called hippos, the sort of senior members of the industry, need to be more vocal, in my opinion, of the dangers of what central banks are doing in terms of where asset prices are going, need to be more vocal about the levels of debt in the world. And I think need to be more honest to people about where future returns are likely to go. I think there's a couple of spaces for new products. One is the sort of the nexus between governments and finance. So it can be partly things like social housing. In some of the Anglo-Saxon and other European countries, there's a big gap in infrastructure. So I think the industry can play a role there. I think it has to rethink the idea of what are safe assets. You know, in Europe, there's sort of one safe asset called the German bond. And as we get probably the next couple of years more financial stresses, different kinds of asset will be found to be resilient or not. And then I think the third thing the industry can do is help the deepening of financial markets in emerging countries, particularly in China. I think that's the next big project in finance, that when China begins to get over its kind of debt mountain, it will create a really deep and liquid bond market in particular. And I think that will fuel a lot of the demand there is for returns.
Fantastic. I mean, that's really interesting new products. So finally, can we sum up if you could sum up the things that the asset management industry needs to do to stay relevant in order to solve these problems? From a leadership perspective, what do they need to do? Bill?
I think it is a little bit to Michael's point. It's addressing those parts of the industry that we've not been able to access before, or potentially were unattractive. I mentioned Facebook earlier. They came in because there was a massive focus in that fintech space of banking the unbanked. Well, perhaps now we've got doing savings for the unsaving at the moment in that sector of the community. And there was an Institute of Fiscal Studies report came out this month saying that there was a higher than ever relative poverty level amongst people who are already in working households. So, okay, they're not very attractive in terms of the amount they might have to save, but as a group, that's an alienated bit of society that the asset management industry isn't looking after today. So, the analogy might be to look at the construction industry, where you've got to have between 30 and 50% of any building development is affordable homes. So, does that have to be something that the asset management industry thinks about? Or God forbid, does the asset management industry rest on its laurels and then suddenly find a regulator comes in and does it? Or perhaps worse still, finds that either Facebook or someone similar goes, okay, if you're not going to do it, then we'll do it for you.
Yeah.
Yeah, I think there's absolutely a need for collaboration. We heard on the previous presentation around that core versus crowd and how you get different solutions. And I think if we keep looking at the same problem and keep trying to do the same version of the same thing, we're going to, over the passage of time, become more and more irrelevant to customers. So let's just get some people in. Let's not fear the disruptors. Let's not fear the innovators. Let's welcome them in. Let's collaborate with them and say, how can we be relevant? How can we be commercially viable? We're in here to be commercially viable, but how can we make sure that we're relevant to give something to the customers where they will want their assets to stay sticky with us, they will have their assets protected while they're with us, and we can demonstrate that we're adding value to themselves while being a stable and good business.
So the obvious partners are insurers, but Michael, you also mentioned earlier about partnering with government over social impact projects as well.
I think so, and I think as this kind of transformation, end of globalization, populism, call it what you want, as this gathers speed, I think governments and big actors in financial markets will have to come together. They've been pushed apart in the last maybe 5 or 10 years because of what happened during the crisis and then the regulatory backlash. But I think they'll have to come together on things like pensions, indebtedness, etc. I think to answer the earlier question as well, I think the other problem is that in an age of diversity, the problem with this industry is the homogeneity of products across all of the, it's across everybody in Europe, the States, etc. In terms of how portfolios are set up, how they're marketed, the techniques, in terms of thematic investing. I mean, everyone's doing kind of slightly different colors of megatrends. And I think the big risk is that we have interesting conversations like this and fireside chats, and then everyone goes back to the office and kind of does the same thing. And I think the area of product innovation and thought innovation is probably not there yet in the industry. And from my own experience, product cycles are just too long and too slow, and innovation is too slow.
So apart from government and insurers, what other partners should we be looking at partnering? What other kinds of businesses?
Well, I think
in this broader ecosystem.
Yeah, I think we need to kind of start looking at, the health industry and what that data is going to talk to us. You look at what Vitality have done as a provider, what they've done with their health and their well-being, and some of the things that Bill talked about. They launched an investment platform as well. So it'll be interesting to see how that health data informs kind of longevity and savings as well as health.
That is so interesting, isn't it? What is happening in that space, and also related to GDPR and what's allowed.
Absolutely.
Yeah.
So it's tricky, and we'll have to navigate it really carefully. But if, you know, from a customer perspective, if they know that if they know what their data is going to be used for and how it's going to serve, that's the exchange. I will give you my data if it's going to drive down a premium. You can put a black box in my car and drive, and I'll drive slower, and that's going to reduce my premium. So where they can see the value exchange, you know, that's an easier sell. If they can't see the value exchange, so if I give you my data about my health and my well-being, and that's going to have a positive impact on my savings, my health, the premium that you want for me, how long I'm going to have to save for, why I should keep it where it is, then let's have that conversation. But at the minute, you know, the distance between what you want from me, advisor, asset manager, insurer, and what I'm going to get from it, I don't know if I've got enough skin in the game for it.
And just on that, I think the risk actually for the industry is that the consumers care less today about banks and asset managers. And the risk is that they will buy those products from the healthcare companies or from the car companies, etc.
Absolutely. And, you know, I was having a bit of banter with one of my colleagues just saying that they're not interested in what sits in a fund and what we buy. They're interested in what it gives them, the cash, the income.
The outcome.
Yeah.
On that note, thank you very much.
Brilliant. Thank you.